I came across this article here from Robert Berzins here on Seeking Alpha, and the article was titled, How to Invest $153,000 for Durable 1,000 Monthly Income. I am so excited to share that today's video is presented by Snowball Analytics. Snowball Analytics is a tool that I use to track my dividend income and analyze my portfolio. Whether you're a new or existing Snowball Analytics user, use promo code DGI to get the very best pricing. Now, I've read a handful of Robert's articles and I like his style. I think he has a lot to add and a lot to offer when it comes to this topic. And the thing that I like the most about this article is it gets you thinking in the right direction. If your goal is to live off your dividend portfolio, this is a great exercise to look and see how other people do it. Now, if you are aiming for $1,000 a month, $5,000, $10,000, $3,000, the number doesn't matter. You can just times it by the amount that you need, and it's all based off of your monthly expenses. The thing that I like most about this article is the way that he approaches this topic of if your goal is to generate, a certain amount of income per month, how do you approach this? How do you tackle this in a responsible, risk-averse way so that you're not putting all your eggs in one basket? And I think he does a good job. So there's a lot of things that I agree with in this article. There's a few critiques that I have that I'm a little bit where I say, you know what, I probably would recommend doing it a little bit differently, but at its core, I think he does a good job explaining what he's trying to do here. And let's take a look at it here. So the summary of the article is assessing current income streams on a monthly basis brings several advantages, both at an emotional and a compound interest level. For prudent investors to capture durable income streams, there has to be a balance between high yield and defense. In this article, I present a sample portfolio that would require $153,000 of initial capital to access $1,000 in monthly income without assuming excessive financial risks. And so the article starts off with him saying that recently I've issued several articles around durable income investing, where the focus is put on defensive, predictable, and steady growing investments or companies. There are multiple benefits of realizing this kind of strategy, such as lower mental stress of worrying about market timing or beating an index, investment objectives that can practically with high probabilities be achieved as, for example, capturing 6 to 9% in portfolio yield, and having to grow above inflation rates requires only finding truly defensive names and avoiding dividend income reductions. I think that's a little bit of an oversimplification, but I agree with him. I think anytime somebody says only, this is only you, all you have to do, I'm a little bit skeptical on that, but let's keep reading. So assessing regularly current income streams that can be opportunistically reinvested or taken out without having to divest portfolio in case such a need emerges. So an additional layer that can be considered in durable income driven strategies is the frequency of portfolio distributions. Most US companies pay dividends on a quarterly basis. In the European markets, the most common payout frequency is 2 times a year, but also in quite many cases, only once a year. Many would most probably argue that it does not really matter how often the current income streams are collected, as long as they come in a full amount and in line with investor expectations. However, I see at least 2 benefits of having monthly dividends. First, for investors who are especially in the active accumulation phase, I actually talked about that here, what was it, last week? About the accumulation versus wealth preservation, so that's cool. There is a possibility for each monthly contribution to be complemented with the already captured dividend income capital, thereby accelerating the overall compounding effect faster. Now, I wouldn't, a lot of people think this, and I actually used to think this as well, is if you're compounding on a monthly basis versus a quarterly or annual basis, that you're gonna greatly increase the size of your snowball. The reality is that the compounding, it does slightly increase it, the rate of your return, but only marginally. It's not go for yourself, go use a compound interest calculator and you can adjust it from monthly or yearly or quarterly. And you'll notice that yes, there will be a difference, but it's such a small difference that it's really nitpicky. I wouldn't focus all of my energy on, I have to get monthly dividends. There are some benefits, but in my opinion, after having looked at the math, it's not so great where it's I have to focus everything around that strategy. But that's just my opinion. You go do it yourself. Go use a compound interest calculator and figure it out for yourself if it's worth it for you. For me, I made the decision that it really wasn't that big of a deal where I changed my entire strategy around it or focus my entire strategy around it. But to each their own. Second, it provides a solid emotional boost of seeing the effort, for example, foregone consumption due to savings, materialize sooner. For example, the moment when one experiences that his or her monthly portfolio income streams become gradually bigger and bigger, the chances are higher that incremental contributions at potentially larger scale will be made just to keep the positive momentum going. So I do agree with him. The emotional benefit of seeing your income come in and compound, it does have you don't want to discount that. The emotional benefit that comes with this is real. I can speak from firsthand experience. From my experience, I can tell you that the fact that I'm currently able to capture an amount of capital through monthly portfolio income that could theoretically cover all of my utility and children's school-related expenses gives me a strong emotional boost and additional motivation to keep the compounding process alive in order to advance to the next level sooner, which would be, say, covering the monthly food costs or anything else that it may be. So he's spot on when it comes to that. I absolutely agree with that. Having said that, investors have to still be careful about relying too much on certain monthly income paying stocks or chasing extremely high yielding alternatives that introduce a high degree of speculative risk in portfolios. In this context, I will present below how I would approach the formation of a portfolio that would generate $1,000 in monthly income without assuming excess financial risks and maximizing the combination of high yield and dividend stability. $1,000 monthly income portfolio. As mentioned above, when it comes to durable income investing, it is critical to avoid value traps or securities that offer yields that are just too good to be true. To mitigate such risks, there are several criteria that have to be in place when selecting individual securities. So the first, highly leveraged profiles. The second, well-established businesses that have invested or operate in defensive industries. And the third, material margin of safety on the dividend coverage front. So I'm assuming he's probably talking about the payout ratio with the third one here, and also, the margin of safety. On top of this, the underlying portfolio has to be diversified, not only on an individual security level, but also on a sector exposure level. Since the universe of monthly income paying securities is limited, especially if we scope out overly speculative names, it is very important to pay attention to the diversification aspect. Speaking of the diversification, the aspect of limited supply of monthly income vehicles, there's definitely a merit of including closed-ended funds and ETFs into the portfolio mix. This way, investors could access a more magnified diversification effects while broadening the option space for selecting durable income generating assets. Last but not least, it is clear that while defense is important, maximizing the yield potentially plays also a notable role. The higher the yield, the lower the required amount of capital that has to be deployed in order to achieve the $1,000 monthly income objective. With these aspects in mind, I've highlighted in the table below the optimal structure of how investors could access $1,000 of monthly portfolio income, diversification, income durability, and importantly, relatively attractive yield to keep the capital requirement as low as possible. So that's really what it comes down to, guys, is if you need $1,000 a month, what you're going to have to do is you're going to have to look at, well, it's just a question of math, right? If the investment is yielding 5%, well, you're going to need more capital to get that $1,000 a month. If the investment is yielding 8 or 9%, well, obviously you're going to need less capital invested to generate that monthly income. But what a lot of people forget, including in this article, which we're going to see in a second, a lot of people forget equally important on the back end, how quickly is that income going to be growing? Yes, he talks about the durability, he talks about the safety and all that good stuff, but how is the income growing? Because you don't want to retire in your early 50s or in your 40s or in your 60s, and then you have 30 or 40 years to live on this earth, but you're not outpacing inflation. So it's incredibly important that you don't just look at the front end, what you're going to be getting today, but how is that income going to grow over time? So let's take a look at his sample portfolio here. This is just an example of how you could do it, how he's recommending you do it. So the first thing that you're going to notice here is the first stock here is Realty Income, which has a weighting of 14%. If you follow the channel, you know that I am dying inside because this is over my threshold of my comfort level of 5% in an individual stock. Now, he's just showing this as an example. He's not saying that you don't have other investments, other ETFs, okay? So I'm not going to go too hard on him here. You also have another single stock in EPR, so 24% of your portfolio is in 2 stocks, right? For me, just way, way too risky, not something that I would ever consider doing, but he does have some good, ETFs in here, JEPI, he has some closed-ended funds in here, and they're all fairly conservatively weighted for the most part. I'm just going to assume that he has another portfolio or a retirement account, and this isn't all that you have, because if this is all you have, this for me is way too risky. I would never have more than 5% in a single stock. But the most important thing that I want to show you here, if you're building your own portfolio and you're watching this thinking, okay, how could I apply this for myself? What you want to focus on is this right here. What is your weighted average dividend yield? Okay, what is the yield that you're going to be getting that is based off of your overall portfolio? Not just one single stock, right? How does it fit in the grand scheme of things? And as I mentioned earlier, he only got half of this right. You want to make sure that you have another column here, which has, the dividend growth rate or the expected dividend growth rate going forward, and you want to calculate the weighted average dividend growth rate as well. But all in all, you hear me talk a lot about the core and satellite, right? This is a great way of how you can look at this. If you were to have a core portfolio, SEHD, DGRO as an example, and you'd have a few satellite positions in JEPI, JEPQ, and maybe, Realty Income was 3 or 4 or 5% of your portfolio. You would do this the exact same way, and this is how you project how your portfolio is going to generate your income. But once again, it all comes back to what are your expenses. So you want to make sure that when you're thinking this all out, this number right here, these things right here, this is based off of this kind of went over. If you're watching on the screen, I don't know why this went way over here. Magic. I'm a wizard, Harry. Well, you want to make sure that you're first starting with. You want to start with what are your expenses, and then you want to work backwards, okay? That's a pro tip that is so important. If you're watching this video, I'm giving you a gold nugget here. If you're planning this all out, start with your expenses and then work backwards from there. Okay? All right, good. So moving on here, let's take a look at what else he has to say here in the article. So moving on here, as we can see, such a portfolio, which is diversified across real estate, private credit, utility, infrastructure, and option-based ETF exposure, requires $153,000 of initial investment to access $1,000 in monthly portfolio income. The weighted average yield of this sample portfolio is 7.8%, which offers an attractive entry point for investors, minimizing the need for large amounts of initial capital to achieve the objective. At the same time, the lion's share of the selected securities are inherently defensive. The securities are subject to a 14% weighting carry, in my opinion, very minimal risk of registering a dividend cut. Well, yeah, except for the single stocks, right? I would be very, very careful when it comes to that. So for example, Realty Income and Main Street Capital are two of the most conservative choices in their specific sectors, real estate and private credit, respectively. Realty Income has an upper investment grade credit rating, well-laddered lease profile, and real estate portfolio that has spread across multiple property sectors and geographies. Maine also has almost the lowest leverage in the BDC sector. So what he's saying here is he's picking the best of the best for each sector that he's diversifying in, right? So he wants to invest into private credit, real estate, maybe in a defensive area. And so that's what he's saying is pick the best of the best, I guess, or that's the criteria that he used when looking at the different investments or the different options. And, you could apply that to closed-ended funds, cover call ETFs. And so I guess the bottom line here, the main thing to take away from what he's saying, because I'm not going to read it out word for word, I'm just going to summarize. That's what he's insinuating here is if you're going to pick your portfolio, that's what he's recommending. Now, whether you do that or whatever, that's up to you, but it's an interesting approach of how to look at this. Now, I would argue if you follow the simple path to wealth with dividend investing, which was inspired by J.L. Collins, which I talk about on my channel, you don't really have to worry about the diversification part because you're already well diversified across sectors with SAHD and DJRO. So you don't have to worry about getting the perfect, allocation of the different sectors. If you did want to get more access to maybe more private credit or, pipelines or BDCs, you could do that as a satellite position. But in terms of individual sectors, you can disregard that need because you're getting that already with the ETFs that you're invested in, at least if you're following my approach or adopting something similar, right? But anyways, taking a look at the summary here. The bottom line, as outlined earlier in the article, investing in monthly income producing securities can bring substantial benefits for investors to stick to the game plan and complement their periodic contributions with already pocketed distributions. Investors have to find a balance between high yield and monthly income stability to keep the initial capital requirement as low as possible while avoiding unfavorable income cuts down the road. In this article, I provided a sample portfolio, which in my humble opinion ticks these necessary boxes for enjoying high and durable monthly income. So that's the article. Let's take a look at a few comments and then we'll wrap it up here. So the first comment here is interesting income portfolio. I own 6 of your 8. My proposed $150,000 for $1,000 a month. Math using 10 funds with $15K per fund. I believe this is a slightly better portfolio by adding exposure to energy, healthcare, and tech. So he's got the dividend yield is what he's referring to here. So he has these equally weighted and he's got, so he's got them equally weighted. He's got SAHD and he's got a few other funds in here. So, okay, interesting. So I guess what I like about this comment is he took what the person in this article said and he has his own way of doing it. Right. And that's what I love about YouTube is you can see different opinions and different ways that different people are doing it. And you can get inspiration from that and you can make it your own. Like, how I always say, inspired by J.L. Collins. My approach was entirely inspired by J.L. Collins because of the experiences that I had trying to figure this all out. If you go back to my first YouTube videos, I had almost like 80 or something individual stocks. And I realized that was not right. At least for me, it wasn't the right approach. And so I've kind of adjusted my strategy over the years. And I finally landed on the simple path to wealth with dividend investing. And I've kind of made it my own through inspiration. And so I guess what I'm saying with this is, when you watch my videos, other videos, you read different articles, see it as a form of inspiration, something that may or may not work for you. And if it doesn't work for you, that's great. Move on to the next thing. But if it does resonate with you, it's a cool way to see what else is out there. But what I don't want you to do is fall trapped to confirmation bias. Don't look at something and think, oh, somebody else is doing it. That means it's the right way. Maybe it's the right way for them. Maybe it's the right way for you. But you just have to figure out that personal finance is personal and you got to figure out what works for you. Another comment here, I like articles like this, how I get my ideas, have an even amount of monthly and quarterly dividends, about $4,000 a month now. So yeah, I really, really like this because it kind of comes back to what I was saying earlier, getting inspiration from articles like this or videos out there on YouTube. It's a great way to find out if you're on, the right path or if there's something else out there for you. So, and I really like articles like this because I always learn something new. I always see what else is out there and different perspectives. And I just really enjoy these kind of articles. And that's why I like sharing them here on the channel. So that's the article. Overall, I would give this article a B+. I really like the idea of looking at your goal of generating $1,000 a month, but also putting guidelines in there to reduce the risk. A lot of what he talks about here is reducing the risks that come with investing in an income-focused approach, right? You could have dividend cutters. There's a lot of different things that you would want to consider, diversification across sectors, different things. So I think he does a really good job at not just blindly going in and saying, okay, I'm going to just blindly invest in these stocks because they have a certain yield, but he has a methodology and it's a methodology that works for him. And I guess the big learning that you can take away from this is if you don't have a methodology, it's about time you start developing one. You can either get inspiration from someone else, but you need to have a methodology of how you're investing, how you're constructing your portfolio. For me, it's the core and satellite. It's the core and satellite, and that's really what I focus on, and it guides me. It's kind of like, it's a little bit cheesy. The core and satellite is my North Star. It guides me and helps me to keep a good balance of risk in my portfolio. Something that I'm not the biggest fan of, I was kind of mentioning it earlier in the video, was the single stock exposure of over 5% into Realty Income, Main Street Capital. You know, yes, they're great companies, but why take on all the risk, right? I would much prefer to allocate more to ETFs or add one or two more single stocks, right? There's nothing wrong with that. So that's just my personal opinion. So if you're looking at this, I'd be very, very careful of how you overweight into individual single stocks. So just my personal opinion. And another point that this article forgot to mention that I talked a little bit about was the dividend growth rate. So how is this income, this $1,000 a month, how is it going to grow in 1 year? 2 years, 3 years, 5 years? How is that income going to grow? Because that is equally as important as generating the $1,000 a month in the first place, because your expenses will go up, eggs will go up, gas will go up, utilities will go up. It's just the way of life. Inflation is a thing. So make sure that you're not neglecting the other side of this, the dividend growth. But yeah, thank you so much for watching, everybody. I hope that you learned something new, and I'll see everybody in next week's video.